You're listening to Seattle Real Estate Podcast.
Hey everybody, I'm Sean Reynolds, the owner of Summit Properties Northwest, Reynolds and Client Appraisal, and your host of the Seattle Real Estate Podcast. So recently I saw, in doing my research for this podcast, I saw an article headline that I kind of passed over initially, and then I've come back to it. And the article headline was, Local Governments are Preparing for Forbearance Fallout. And that didn't make any sense to me because local governments don't have mortgages, and the forbearance program is for people who can't make their mortgage payment and they're getting a forbearance. They're getting the ability to not pay some of those payments and figure out a plan to pay them later. So why are local governments preparing for forbearance fallout? And so that's a story that I've been kind of researching, and I understand now in doing my research why this has such a massive impact and why your local city could potentially really get rocked due to the mortgage forbearance program. So that's what this podcast is going to be. Thanks so much for tuning in. If you're watching on YouTube, hey, how you doing? And if you're listening on the podcast platforms, thanks so much for listening. Really appreciate it. So as part of the CARES Act, that's the big $2.2 trillion package the federal government set up at the onset of the coronavirus outbreak. What they did is they mandated that Ginnie Mae and FHFA, those are basically governmental bodies to do with housing, they are giving mortgage forbearance for up to 6 months for people who can't pay, and then you can extend it for another 6 months. So those people don't have to pay their mortgage. Now, your mortgage typically covers 4 components. It covers principal, that's the amount you owe, interest on the amount you owe, taxes, and those are property taxes, and insurance. So it's a PITI payment, P-I, principal, interest, taxes, and insurance. So in the CARES Act, what's been known is that servicers, they're the guys you write out your mortgage to, your check to. Every month you write out your check, and you might be writing it out to your servicer who is the same as the lender, but the mortgage servicer might also be just passing through your money to the investor. And the big deal with forbearance is that servicers, even though you're not making your payment, those servicers still have to pay their investors the principal and interest. They have to pass that through. Now, the 2 factors that have been kind of passed over in this have been your taxes and insurance. Why is that a big deal? Well, insurance covers the asset of your home. So I think insurance will be taken care of. Servicers will cover that insurance payment because it's a pretty small amount, and they want to make sure that both their investors and them and they as the servicers are taken care of. But taxes, that gets passed on to the governmental body. And who benefits from property taxes? Well, the individual cities. Your city does. Now, the cities don't have as much pull as either the state government or the federal government. They are really dependent upon your tax dollars right now. And with so many people having forbearances, and we're going to get into those numbers, and the servicers, we don't know what the impact's going to be on the servicing companies, whether they're going to be able to withstand all of this pressure to have all these people not paying and then the servicers still making payments to their investors on the other end. So there's all of this food chain that's in line, and ultimately the individual cities, I think, are going to take a massive hit because most cities right now and states are already having a big either income tax hit because so few people are working. We've got 33.5 million Americans that have applied for first-time home unemployment insurance. And then you've got an unemployment rate of, I think, 14.7% of the workforce. And a lot of people think that that's more like 20% because so many people have not been able to get through to their unemployment centers, just physically can't get through. There's so many people calling in. So what happens with individual governments? So property taxes are the single largest source of tax collections for localities across the country. Super important, property taxes. And most local governments do not have significant reserves to allow them to close out a tax year or provide services. That's where this all kind of comes to, is you're going to see a bunch of services possibly get cut and a bunch of social service type structures and programs not have any funding. So there's going to be a scramble. I think you'll still see, the majority of programs continue because these states will ask for federal funding as part of this pandemic, and they'll probably get it. State of Washington today, where I'm in the city of Bellevue, just east of downtown Seattle. State of Washington, along with 4 other states, along with California, Colorado, Oregon, and Nevada, they're asking for $1 trillion from the federal government. Washington's got a $7 billion budget shortfall. So state governments are already in trouble, and this is going to trickle down to your smaller towns. So most local governments do not have significant reserves to allow them to close out a tax year or provide services if collections are extended for some lengthy period. Now, King County, the county I'm in, has already extended out, I think, until July. You don't have to pay your property taxes until then. But there's a limit at which this tax money needs to roll in to cover all of your local government obligations, financial obligations. So in 2016, this is the article I've kind of researched, property taxes contributed 72% of local tax collections from across the country. The average property tax bill for a single-family home is about $3,500. That was in 2016. In a time when cities and counties are grappling with depressed revenues from income tax and sales tax, got to remember, when there's no stuff being sold, there's no taxes being implemented, and there's no tax revenue from this stuff. You just don't have the taxes coming in. And during this time, property taxes are a vital source of funds, which, underpinned by steady real estate values, supports school districts and various services. So your school districts are at a real risk here because the way they get funded is through property taxes, and with a big percentage of mortgages in forbearance, there could be a real interruption on the cash flow to fund your school and a bunch of other social services that I'm not going to get into. But just think tax revenue for your town, it's not there. So all that money that should be paid or could be paid or most likely will be paid, it's just going to take longer. You've got a cash flow crunch. And that's exactly what we're talking about. Property taxes are an extraordinarily stable form of revenue right now due to property values. Property values have been going up. So, municipalities continue to get increased revenue. And that's important because the smaller municipalities have fewer tools at their disposal to address shortfalls than do states or the federal government. Last week, and this was as of, I think it is truly last week. I'm recording this podcast on May the 12th. So last week, nonetheless, the Federal Reserve established a municipal liquidity facility with the purpose of purchasing $500 billion of short-term notes directly from states and counties with a minimum of 2 million residents, as well as cities with a population of at least 1 million. So the Federal Reserve already recognizes that you're going to have some massive budget shortfalls, and they are covering the bigger states and bigger cities with some funding, with buying basically $500 billion of short-term notes. The measure to inject liquidity should allay some of the COVID-19 induced economic stressors on local governments. But that's not going to cover it. You've got billions and billions and billions of dollars that are basically putting governments out of their budgets are just rocked. So forbearance is typically acceptable when you don't have a massive run of mortgage holders doing just that, asking for forbearance. So servicers are set up to pay forbearance through either their own cash, their own lines of credit, or if they are a non-bank entity and they don't have their own cash, they don't have their own deposits, that they've got their own cash or their own lines of credit as well. So it's slightly different. If you're a bank and you are a servicer, you've probably got your depositors' deposits in order to help you out as far as a cash flow thing goes. But If you are a non-bank entity, you're going to have to rely upon whatever you've got to kind of get you through. And no servicers are ready for the amount of mortgage forbearance that's going on right now. So let's look at some of those numbers. As of April 30th, 7.33% of all the mortgages out there are in forbearance. So 7%. That doesn't sound like a huge number, but it is. And it's probably going to climb anywhere to, on the low end, maybe 8%. I think that'll be more, but up to 15%. And 7.33% is 4.1 million loans. So 4.1 million loans are in forbearance right now. And that's $890 billion in loans. So getting close to $1 trillion of loans are in forbearance. What does that transfer to? And that's principal, interest, taxes, and insurance. That's total shebang. So there's two different ways you can pay your property taxes. You can either pay them on an installment basis. You make your payments quarterly, semi-annually, whatever, to your local government. And about 17% of all mortgage holders, that's how they pay. They make their own payments. So to their local governments, 83% have them made through their escrow payment of principal, interest, tax, and insurance. So you have the option with certain lenders. A lot of lenders are going to be like, nope, we want this all taken care of at one payment. You're going to write out a check. It's going to cover everything. But you do have that option. So of the escrow payments that are made, here's what that equates to. So the cash flow exposure that small towns have, so the revenue that's to be expected from the tax portion of this $890 billion in loans so far, here's what those numbers look like. So if we go to an assumed 15% mortgage forbearance, when we're all said and done, 15% of all mortgages out there need a forbearance of some period. So between now, which is May, and December of 2020, you are looking at somewhere around $13 billion of property taxes not being paid if this is the case, or potentially not being paid. That's at risk. If we're on the low end of kind of how this forbearance things goes, if maybe only 8% of all mortgages need a forbearance, then you're looking at probably somewhere around $8 billion in property tax revenue that individual municipalities might miss out on. So it's an enormous, enormous number. And that's why I think a lot of municipalities are already extending out their deadlines for tax payments. I know King County has kicked it out, their timeline to July to make your tax payments. Now they're just extending it out. They're not saying, hey, you never have to pay it. They're just extending it out. But like I said earlier, there's only a certain limit to which you can extend things out, and then there becomes a massive cash shortfall. And that's where I think the states are basically setting up the federal government for, all right, we are going to need some big time loans to get us through this, because property taxes, we're not going to see a whole bunch of those. Income taxes for states that have income tax, well, that revenue is way down. And then state sales tax for states that have sales tax. How much stuff is not being bought? People are sitting at home. And that's why I think there's such a big push right now. That pendulum has swung the other way from stay home, stay safe, wash your hands, to, all right, what's the time frame for going back to work? Because all of these economic factors in a consumer society like we have, they all work together. And right now, none of them are working. And so that's why I think the mortgage forbearance program is going to have a way bigger impact, and especially on local government, than people have kind of thought through. Because nobody's people are just reacting. Federal government is just kind of reacting. Pump that Paycheck Protection Program into the economy. We don't really care how you do it, but get that money going, take that money, spend it. We're kind of hoping that you spend 75% of your PPP loans on your payroll, on your employees. But we kind of know that your employees also have some really good unemployment benefits right now. And on top of the $600 a week extra payments that people are eligible for, And so there's just a lot of money being pumped into the economy. And that's because I think the government basically knows that when we do go all back to work, the landscape of employment is going to be wildly different than when we left. People are going to work from home a lot, but a lot of those businesses are going to have a tough time working through all the requirements to do the safety thing with social distancing, especially restaurants. They're the ones that are just really getting smacked in this shutdown and reopening. Because the levels at which they're going to reopen, those are loss leaders. Restaurants and bars are not going to be able to make money unless they, well, from what I've read, they're in the bar owners that I know, they're not going to make any money unless they sell an incredible amount of alcohol. And you might have a couple of nights where that happens right out of the chute when we're able to go back. But I think for the most part, people are still too freaked out and they're too scared to really go out. I will go to the gym and I'll probably go to one restaurant experience just because I want to have it. But I'm not really running around just because, the whole thought of, all right, if I do run into somebody with corona and maybe genetically, I don't know, maybe genetically I'm not built to take it. It's not something I want to do massive exposure to. I'm not afraid of it and I don't really wear a mask. And I know people don't really like that, but it's kind of my choice. Am I in environments all the time where I'm around people constantly? No, I'm isolated most of the time. I do come into the office, but we kind of keep our distance here. Not necessarily purposely, but just the way we're set up, we're at least 6 feet apart most of the day. So that being said, I think you're going to see some pretty major headlines here with the mortgage forbearance and how that impacts your local government. Now, I do know New Hampshire, Idaho, Iowa, and New York are all in the process of kind of making plans. And there's probably a bunch of other states and cities and counties that are making plans for, all right, if we don't get the revenue coming through like we think we do, what do we do? And so everybody's kind of making contingency plans. Employers are making contingency plans. What if I can't pay rent? What if I can't pay my employers? All of this is up in the air. So this is going to be a big news story, I think, moving forward on exactly what will happen. And kind of going back to the big ticket items is the amount of money that is total expected municipal property tax payments, and this is between May and December. So this month, May and December, you've got about $91.36 billion of property tax payments that are made through escrow. So that's an enormous number. And then when you have either 8 or 15%, somewhere in that range, that choose forbearance, and if these servicing companies aren't able to hack it, if they're not able to handle it, if they don't have the liquidity, they don't have the lines of credit, then we're kind of toast. I think the government will probably step in and provide some liquidity structure, but you got to get there first. Look at how long the PPP loans have taken for employers who desperately need money to pay their people. Look at how long that's taken. I mean, a couple of months. And it's largely due to, this is a brand new program they came out with, and you've got what now, like $4 trillion of funding. And a lot of it is going out, and we are having, we've had a second funding already, and it's just hundreds of billions of dollars that are being pumped into the economy because basically there's not much happening. So $91.36 billion is an enormous amount to have kind of at risk with how these servicers are handling things. And of all the escrow payments out there that are made, about 61% of them are made to bank servicers. Those are just servicing companies. They pass through your money. They take your principal, interest, tax, and insurance payment, and they pass along the principal and the interest to their investors, and then they make sure your homeowner's insurance gets paid, and they pass along your taxes to your local municipality as you've got it set up. So 61% are made by bank servicers, and then 39% are made by non-bank companies. So you've got two really good-sized entities in there that may or may not be able to handle the pressure put on them because they're caught in the middle. They've got no money coming in from the borrowers. You've got the mortgage forbearance people. There's no money coming in, yet they still got to pass it out on the other end. And we know principal and interest are supposedly taken care of. We're just not sure on the tax and insurance. There's not a lot of direction on how that's going to go on with a massive mortgage forbearance program like what we've got on. So what are the factors that will impact the servicers? Obviously, how long will the coronavirus continue to go on? We don't really know that, but a lot of local economies are getting ready to reopen. We don't know what the consumer response is going to be on the other end, but it's probably not great. I saw an article where the United States savings rate is at levels not seen since the 1980s, since when I was in high school. I graduated in 1987. So apparently in the 1980s, I don't remember it because I don't think I had any savings. I wasn't really working, full-time yet. But our savings level back then was significantly higher than it is now. But people right now are saving, number one, because I think they don't have a lot of options to spend their money on. They're not going to the stores like they normally would. They're not going to the mall. They're buying necessities and they're putting cash away because they're afraid of what the future is going to bring. And they are not doing what's essential to a consumer economy, which is consuming. So without that factor, without people out there buying, they're saving a lot more, which is a double-edged sword because then you don't have all that cash pouring into businesses that really need it right now. It's like having the payroll protection or the paycheck protection program in place and small businesses have to use it within 8 weeks. But how many of them still aren't open? In the state of Washington, our phase 2, which allows restaurants to open up, isn't going to be open until probably June 1st. And I know a lot of restaurant owners have already gotten their PPP loan, and they're trying to spend it on payroll, but you're not doing a lot of business. So how's that going to go? We don't really know. It's kind of like the mortgage forbearance. We don't really know how it's going to go with servicers, but my guess is probably not well, and we're going to need to see some bailouts at the other end. So how long will this go on? That's the major concern, and that kind of dictates how many people choose to do the mortgage forbearance. One of the news stories I heard this morning on CNBC was that there was an individual who his bank called him up and basically gave him this offer he couldn't quite figure out. It was a forbearance offer. He took it. He didn't realize it was forbearance because they didn't really use the term forbearance, but it was. He went to go refinance his loan, and Fannie Mae and Freddie Mac, basically the big government-sponsored enterprises that kind of run the secondary mortgage market, they're the ones that have all the money and basically own a lot of the mortgages. They have a rule that if your loan is in forbearance, you can't refinance for a year. So they consider forbearance to be not paying up your loan in time. So that guy was like, wait, what? I'm in forbearance? So there's some instances of that, and maybe he just didn't understand what he's doing. But I guarantee you on the paperwork he signed at the top, it said mortgage forbearance, something like that. But that was a news story. So there are instances where people don't realize, oh my gosh, the mortgage forbearance, it has a lot of implications down the road. And one of them is kind of this podcast storyline. And that's why one of the major news stories I think you're going to see is local governments are preparing for forbearance fallout. Another factor is how quickly we recover. So how long is this going to go on for? How many people take the mortgage forbearance? How quick do we recover? And then quite simply, how much liquidity do these mortgage servicers have before they're like, uncle, can't do this anymore, don't have the money to pay out the investors, don't have principal and interest, don't have the money to pay the local governments the taxes we're supposed to pay them, and don't have the money to pay the insurance. It's in their best interest to do so because that's their business. They make a little bit of money over the course of years of servicing your loan, and the investors make money on basically the difference between what they pay for your money and what you've borrowed from them. So everybody needs to make this work, but there's a limit to how much the servicers have as reserves to basically make your payments if you're in forbearance. So a lot of this has to work. It all works together. And I think you're going to start to see the wheels coming off. And this is kind of just one simple example of how people are thinking, okay, yeah, mortgage forbearance, this is awesome, this is great. Well, when you start to see social services that you really need in your town close up or temporarily shut down, this is one impact from them that people haven't really thought through. Government money is your taxpayer money at work. And when the money isn't going through, you've got problems. So hopefully we'll be able to figure out a liquidity solution. The Federal Reserve or somebody, the Treasury Department, will provide liquidity for government servicers so there isn't the interruption when people don't pay their mortgage and they need a forbearance to the end result, which is the local municipalities getting their property tax payments. So hopefully we don't get to that, but you could. And the mortgage forbearance has a lot of implications, much further spread than you as the mortgage holder just not being able to make your mortgage payment. It impacts a lot of people down the food chain. And I've done a complete video on should you do the mortgage forbearance. And more people are basically saying, hey, don't do it if you can't. And that's been my stance all along is if there's any way at all that you can make your mortgage payment, make it. Because I think you're going to have impacts down the road that we don't quite know yet. We're going to have credit companies look at forbearance differently. Lenders look at forbearance differently. Fannie Mae and Freddie Mac are basically already saying, hey, if you take a forbearance, you can't refinance out of that loan for a full year. So you're stuck with that loan. If interest rates drop, like I think they will in 2021, you won't be eligible to get that lower rate and possibly reduce your mortgages. So look at forbearance super closely, do your research. Don't just bail out because you think, all right, this is free money. I don't have to pay my mortgage. This is great. Think about it. Look at everything. Watch a ton of YouTube videos by CPAs. Don't follow some goofball who isn't qualified as a financial planner. And I'm just a real estate guy. So I own an appraisal company. I own a real estate brokerage. Yeah, I have a lot to do with mortgage payments, and I work with mortgage lenders all the time. So I kind of know the ins and outs, but don't take my advice 100% either. Reach out to a CPA or somebody who's got a financial background to find out if you're out of work, or if you just have a cash flow issue, maybe you've been furloughed, whatever, on your mortgage payment. Reach out to somebody that's qualified to give you their best opinion on whether or not you should do the forbearance if you're in that position. I hope you're not, but yeah, we've got millions of Americans who are, and it's probably going to increase before it gets better. So hang in there. It's about all I got for right now. All right. Thank you so much for watching if you're watching on YouTube, and thanks so much for listening on the Seattle Real Estate Podcast networks. Again, I'm Sean Reynolds from Summit Properties Northwest, Reynolds and Klein Appraisal. We'll catch you in the next one. Thank you. Bye. Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.